we're going to jump right into this. Good evening. I'm Phil Brendel. I cover distress situations for Bloomberg Intelligence. As this is the last interview of the evening, I'd normally say I'd be expeditious so that it all can hit the bar, but that isn't necessary in this format. Thanks for everyone for listening in. I'm excited that Richard Shinder of Ensis Partners agreed to join us tonight. Rich, thanks for joining us.
Thank you for having me.
I first met Richard around 2008, 2009 when he was representing Accuride, and I was at BlackRock, which was one of the largest note holders with Brigade Capital. One of the great things about this space is that you can develop quick, deep relationships through intense deal interactions. And that can make reaching out to them easy years later, if not decades later. So anyway, a quick bio. Its time is precious. You went to Gonzaga undergrad, Wharton MBA.
Go Zags.
Go Zags. Started at Lehman Brothers in Lev Fin. You were on Blackstone's restructuring team during the early 2000s.
That's right.
And Rich landed at some of the premier distressed players on the buy side in the aughts and teens, Avenue Capital, Goldman SSG, and TPG Capital, interspersed with advisory roles at Perella, and where you were partner and group head role at Piper Jaffray. And that takes us today, and this is the exciting part. You co-founded Ensis Partners with Mark Bushman earlier in the year, targeting middle market restructuring. Okay, I promise that is enough for me. Rich, please talk to us about Ensis, the opportunity set, and the services you are providing to the middle market space and private credit.
Well, thanks again, Phil. So let me spend a few moments on Ensis. So we launched Ensis Partners earlier this year at the beginning of February, but it was really, at launch, it was a culmination of a long journey, a long professional journey for my co-founder, Mark Bushman, and I, and then more specifically, really a one-year prep period prior to the launch of the firm, where we went out and raised outside capital, built the infrastructure of the firm, did all the fun entrepreneurial things like building a tech stack, getting office space, and the like. But it was, I think for both Mark and I, it was a culmination and a shared vision around identifying a white space that we saw in the restructuring market, which was specifically the fact that the middle market has grown significantly through the growth of private equity activity in the middle market, as well as all our listeners know, the breakneck growth in private credit. And what we identified, and I had seen this as an investment banker, as a principal, and also as a fiduciary, is a supply-demand mismatch that started to emerge, that the demand for sophisticated elite restructuring services continued to grow, and we think really in this last year while we were preparing to launch a firm has really accelerated given some of the headlines of private credit. And yet the supply of capable investment banking restructuring advisors really wasn't matching that increase in demand. And with all due respect to our competitors who are very good and capable firms, what we observed is that many of the very established boutiques that both Mark and I have worked at different points in our career have continued to go up market and focus on mega cap deals, with very large fees, and they've done a great job of exploiting those market opportunities and being profitable, but maybe are too expensive, or the value proposition is not as compelling for smaller companies. And then at the other end of the market, smaller boutique investment banks focused on restructuring have tended to be more distressed M&A oriented, because that used to be the toolkit for middle market restructuring. If a defaulted borrower, with a private credit lender or with a commercial bank syndicate found itself in a rough patch, typically the only option that the parties would identify is a quick sale of the asset. And so our approach is to bring that large cap toolkit and a broad range of services, including capital solutions, creative Chapter 11 restructuring, and yes, distressed M&A, but again, through the filter of some of the techniques that were developed upmarket, like LMEs, like cross-border insolvencies, and using offshore jurisdictions to achieve things that maybe can't be achieved in Chapter 11, into the middle and upper middle market. And so That's my story, and I'm sticking to it.
No, that's great. And in terms of one of the things that we consistently hear about middle market and private credit is how important relationships are, and that like the people who are financing companies have these deep relationships with the sponsors. It's not just for one company; it's like for a slew of different companies across the board, and that makes the workouts that much more tricky because there's these other interests at play. Can you talk a little bit about that dynamic?
Yeah, I mean it really is. Even though there's a lot of shared technology, and clearly Chapter 11 is Chapter 11 across the large cap markets and down into upper middle and ultimately lower middle market. There are really distinct ecosystems and different transaction formats, and a lot of it ensues, Phil, from what you were just saying, which is particularly with the growth in private credit. Private equity is such an essential, in fact, it is the essential sourcing channel for direct lenders. And so, given that, and this is again sort of feeding off the headlines, but now that we're in a more disrupted credit environment, a higher for longer environment, following a decade plus of basically zero interest rates. Those relationships are now being tested, and because private equity is the primary, if not exclusive, sourcing channel for direct lenders, the approach to restructuring is very different from what you see in large cap, where it tends to be more of a zero-sum positional bargaining dynamic between lenders and companies, and lenders on the one hand, companies and sponsors on the other. Um, Direct lenders know that if that they will see these sponsors again because they are their source of business and they are essential to their franchise. And so there's a need, as an advisor, there's a need to help mediate those solutions in a way that recognizes that this isn't a transactional approach, but this is a continued and will be a continuing relationship between these parties, even if not necessarily on this credit, but on other credits because of the volume of business they do together.
So it sounds like deals might actually be easier to find or arrive at.
Yeah, yes, in that regard, because there is the sort of mutuality of the relationship. But I'd say, on the other hand, maybe some countervailing factors are certainly in the middle market. And again, I talked about a moment ago the distinct ecosystems. In the middle market, the rule of thumb that one has in large cap around essentiality, or does this business have a reason to exist, that's a much harder question to answer in lower middle market situations. And so some of the techniques that you'll see in large cap restructuring, like LMEs or priming financing or raising junior capital, those are relevant in the middle market, but they can be harder to effectuate because that reason to exist question sometimes has the wrong answer. And so, yes, while there's mutuality among incumbent investors, it can be harder to induce capital formation from third parties. And so, you've got countervailing tendencies. And so I wouldn't want to leave anyone with the impression that, oh, middle market restructurings are easier because they're collaborative. There are other exigent challenges that inform it.
And I imagine typically there might be 5 to 10 lenders in a little club. It's like 2 might have the relationships, the other 8 have the relationship with those 2, and you get some interesting dynamics.
That creates its own challenges. That's right.
One thing I want to touch on is the lack of transparency, and this is something that I always think is fascinating with private credit. Is like the price can be very static, and in these portfolios, and there's not a lot of information there. But when people start looking to get out of their positions or there's distress, people start thinking about and how do you get buyers up to speed and like that kind of thing, in terms of workout situations?
Yeah, it's challenging. I mean, as you indicate in the question, it can be very challenging to educate third parties, and the bar is so much higher. You've already got an incumbent or an existing capital stack, that is illiquid, and now you're trying to induce third-party capital formation, and yes, these are private markets, so people are prepared, to go under config and do the work. But oftentimes there's such an asymmetry, and I think that's the one of the biggest challenges in private market, and specifically in middle market restructuring with private credit, is that there's such an informational asymmetry between incumbent investors, meaning the direct lenders who are in the deal and the sponsor, and new parties, that it can be harder to bridge that bid ask. And certainly in public markets, you have that same dynamic, but not to the same degree. And then this is where price transparency as a signal, and we all learn that in Econ 101. What are prices here? A signal to buyers and sellers, and the same thing exists in capital markets. And if you don't have that price signal, that can be a deterrent to getting things done. And as an advisor, one of the things I often think about is all eyes are on public names, and so there will be inbound, whether it's lawyers or investment bankers, certainly investment bankers, or financial advisors. If we see a company whose bonds are trading at 80, we'll put our feelers out and try to find out, is there a role for us? How can we be helpful? Maybe we've got an idea that we use for a company in a similar industry or in a transaction that may be applicable to this circumstance. In private market situations, and again, especially as Covenant Light has crept into direct lending, a lot of times you've got parties who are just playing out the equity option, until the company is quite literally at death's door, and so the solution set narrows considerably.
No, it's fascinating. We could go on probably talking about that information wall forever. I want to touch on what makes up a lot of private credit: technology and software workouts. AI is changing the landscape, or is at least reported to be. I mean, we're hearing about it. And I grabbed this quote from Apollo's co-head of private equity, David Samber, in a recent paper. He said, software moats are not disappearing. They are becoming more permeable and less predictable. The old assumption that seats, annual recurring revenue, and multiples would expand predictably is being challenged. And it's just hitting on the point that obsolescence risk is picking up. What are you seeing in this space?
Well, I would agree with the quote, and I think what's important in that is, from an underwriting perspective, if you're a lender or even a committer of equity capital, you're always looking for a defensible business model or something that does have that competitive moat. I think the fact that now, after, let's be honest, a 10-plus year period of valuations and leverage ratios in technology and SaaS-related businesses, sort of, like trees growing to the sky, people are now revisiting that. And I think, you are starting to see, and it is not, despite the headlines, it is not yet a SaaS-pocalypse, and I'm not convinced there will be a SaaS-pocalypse, but it may be a re-rating of risk and a repricing of valuations. And I think, some of the consequences of that are, certainly, and one of the firms, that you mentioned on my resume was a forerunner in recurring revenue lending. I think the market will revisit, recurring revenue extensions of credit. Like, how do I underwrite recurring revenue when my confidence interval in churn and sustainability, and can I hive down my risk quickly enough if this business starts to degrade quickly? I think people will start to stress test those models a bit more. And I think the other, and you asked about technology, but I always like to try to get behind the headlines a bit. I think the perhaps relaxation of underwriting discipline in technology, which has cast private credit in a harsh light and led to gating and redemption requests and all the things that we again all see in the headlines, is also bringing greater scrutiny to non-software related underwriting and really causing a desire among investors and market observers to really look under the hood of what effectively is shadow banking and what some of these private credit platforms are really doing.
Yeah, I just a little anecdote is I'm I'm understanding from people like who are signing software contracts, they're saying, yeah, with AI these days, I'm only going to do it for an annual, 1 year, and there's no long 5-year subscription model. It's really disappearing quite quickly. Um, so it'll be
Who
interesting.
wants to extend a 5-year loan with the average life of the contracted revenues?
It's almost like your cable
compressing.
company, right? They'll lock you in at this price. It's like that's not necessarily a favor.
People are unbundling.
Yeah. So let's touch on the private BDC market. Much has been made of this model of redemption gating, no market pricing. Talk about the challenges of working at a situation when potentially private BDCs are sitting there and you know that they're facing gates, that they're facing redemptions that are and have their gates up.
It's fascinating, and we're still, even though the headlines have been coming fast and furious, we're still in the relatively early innings of what's going on with private BDCs.
Well, it could take 5 years to get your money out.
It could take 5 years to get your money out at the at the gate percentages, but a rule of thumb in lending is that you need capital to support your investments and your positions, and so if you imagine platforms like private BDCs that are experiencing net outflows, there's an obvious challenge that if you need to deploy capital in order to make sure that a restructuring doesn't turn into a liquidation, but you don't have that capital available, you're faced with a number of bad options, which is accepting third-party capital that may help solve the situation, but at the expense of the credit quality and collateral profile of your position, or if you're unable to induce third-party capital to enter the situation as a capital solution, the risk of liquidation versus a restructuring or recapitalization.
Yeah. So let's talk exit strategy. What are private credit institutions' appetite for equity? And does that create an opportunity that these funds are typically set up for debt and performing debt?
I mean, it's interesting because if you and I have been around, for a little while, so we can remember, different market environments with different types of players. And once upon a time, you had bank lenders who couldn't or wouldn't hold equity. What's interesting about the private credit space is you do have, in some cases, you have limitations, whether they're documentary or cultural or business model wise. Prohibitions against holding equity. In general, direct lending platforms can hold equity, but are they equipped to hold equity? And are they equipped, perhaps more importantly, not just to hold equity as part of either a credit bid in a bankruptcy or as part of a debt for equity conversion in an out-of-court restructuring or a Chapter 11, but do they have the resources available to them to really own companies? I mean, one of the interesting analogs with large cap restructuring is CLOs and bond investors in large cap Chapter 11s are very familiar and very accustomed to and comfortable with owning equity in reorganized companies. And part of the reason for that is typically that equity is widely distributed. The companies are large, and therefore their management and accounting and finance functions and their entire organizations are professionalized. And so being a 7% holder of the equity in ReorgCo that had been a $20 billion cap stack pre-restructuring doesn't feel scary. It doesn't feel like, okay, who's going to drive value to make sure I maximize my recovery on what had been my pre-petition bond position or loan. In middle market private credit, you have to think more like a sponsor because you may be the sole owner of this company or you may have a significant equity stake. And many of these private credit managers, some of them are part of alternatives platforms where they can draw on operating partner resources and private equity colleagues who can help preserve and accrete value in those positions, but many of them don't, and that can make the solution set in a restructuring more challenging because you really do have unnatural holders and in many cases unwilling holders of post-restructuring equity.
Thank you. Private credit workouts, where do you see players compromising and saving money? There is a constant refrain on how companies can't afford bankruptcy.
So I think this is taking a couple of different forms. And so you've seen it in large cap already with the expansion of LMEs, and that technology initially emerged because there was a view among market participants that Chapter 11 is too expensive, so why don't we do our financial engineering outside of court and save money? Well, when 7 out of 10 of those companies, roughly speaking, ends up filing anyway, that sort of gives the lie to the cost savings approach. I think in middle market private credit, where certainly where I'm focused, I think there's a couple of different ways to make restructurings more efficient. I mean, there's certainly, and it really depends on the circumstance, but whether it's doing things out of court, having a single advisor sort of mediating among sponsor and private credit, like we had talked about before, just given the nature of those relationships, that can help reduce costs. One thing that we're thinking about in our business model is providing some limited amount of FA services so that 2 advisors can become 1 or 1.5 and make that more cost efficient. But then I think there's also the use of different resolution formats, whether that's use of UK restructuring processes or Dutch WOA or in concert with the Chapter 15. You saw that in the fossil group restructuring with the UK aspect of that.
We've seen it with big capital structures. Our dog went to Luxembourg, and we're seeing it. NFA is.
That's right.
Chapter 11.
And it is interesting how a lot of this technology that's developed up market does filter down into smaller companies where it's relevant and appropriate. So I think you'll continue to see that. And then certainly as you move into even smaller capital structures, there's a lot of interest in Article 9, in ABCs in jurisdictions where that's appropriate. Now, all of those resolution formats have their pros and cons, and cost is not the only issue for the participants in those. But there's definitely a lot of interest in finding alternative ways to resolve these capital structures.
So, Rich, I know one issue you've given a lot of thought to are potential systemic risks. And you aren't the only one. Actually, Alan Waxman of Sixth Street on a recent podcast described the mismatch between private wealth investors and assets that gate exits as a mismatch, and that he didn't think that it was systemic, but he thought it was a problem. What are your concerns here?
Well, and Alan hit on something important, which I have focused on a lot, not just in my work but in my writing, which is the fundamental asset liability mismatch endemic in private credit, and the fact that private credit has increasingly, within the last 18, 24 months, been sold as a product to retail investors, where you've got this fundamental mismatch between an investor class that wants liquidity and an asset that is illiquid and intermediate term lived. It just seems like hilarity will not ensue from that relationship. And so certainly, pardon me, where those assets are held in taxable accounts, it doesn't seem appropriate for the retail channel. From a systemic risk standpoint, this is something I've spent a lot of time on. I was probably, the old joke goes, it's better to be early than wrong, but I think started writing about the potential for systemic risk ensuing from private credit back in 2018. And have written on it a few times and spoken on it since. But the core of the concern around systemic risk is that because of the regulations that ensued from the great financial crisis and the appurtenances of Dodd-Frank, including the leveraged loan guidelines and sort of all the rest of it, you really chased middle market, what used to be commercial banks doing C&I lending, and I'm showing my age and saying that commercial and industrial lending, you chased it into a shadow banking sector, which we call private credit. There's nothing wrong with that. No, people respond rationally to the incentives that are presented to them, and the GPs that run private credit funds are rational actors. And so the risk is, and I might add, I'll put one asterisk on the rational part of it, is that it always struck me as odd to take it, what is fundamentally a net interest margin business, and put it into a carried interest format. That always struck me as strange, but I'll get off my soapbox. But the real concern is that by moving the lion's share of commercial and industrial lending out of the regulated banking system into shadow banking, is that if there are issues, and we see this now with private BDCs, as you mentioned a moment ago, what happens when that part of the plumbing of our financial architecture, where you're mediating credit from savers to borrowers, starts to break down? Now, I say that recognizing, banks still exist, and can they stand up lending, commercial lending businesses, fairly quickly? Of course they can, and they haven't atrophied in their entirety. But I do think there is a risk, if not necessarily of a future financial crisis, certainly market disruption that leads to intermediate term increases and potentially significant increases in the cost of capital for middle market companies, because you've got a channel, meaning private credit, that may have a significant portion of it where the disruption that ensues from a deterioration in credit quality, those costs are not internalized. I mean, that's always the point that I've made in the myriad pieces I've written about this, is that if a hedge fund blows up, if a segment of the private equity world disappears because you've got market players that are in a crowded trade that's a bad bet, the losses are internalized. Problem with credit is essential to the functioning of a modern economy, and if credit markets don't work properly, and we saw this in 2008, it's a problem for the real economy. It's a problem for everyone. The costs are externalized, or they're negative externalities, and typically they end up falling on the taxpayer. And I might add, a more diffuse credit market, it's a lot harder than it was in 2008, where you called all the big commercial and investment banks into the New York Fed, and you could say you're taking TARP money because we need to reinstill confidence in the global financial system. That's going to be a lot harder when you have sort of 1,000 points of light of allocators of credit versus 7 to 10 large too big to fail financial institutions.
No, that's a great point. The absence of that channel, that funding vehicle, that funding source is just could be a bigger problem for the real economy that people are contemplating. Okay, crystal ball time. Just to wrap this up, what are you seeing out there? Sectors? What are you seeing that you'd consider that's typical for where we are in the cycle, and then what's surprising?
Yeah, I mean, sectors, we're not in an environment right now like we've seen in the past where, oil and gas is underwater because of commodity prices, or this sector is in trouble because of whatever regulatory policy. Or
I can tell you, energy is zero distressed. High yield bond market,
which is
zero.
insane, because we've all lived through times that were the exact
2016 is more than 10 years ago at this point.
Well, that's true. But we're seeing some emerging issues. I mean, we've spoken about software. We're seeing issues emerging in automotive. I mean, automotive has been just batted about. You've had tariffs, you've had disrupted supply chains from the end of COVID. You have regulatory ping pong afoot with EVs, and so I think there's probably more to come, particularly in the tier 1, tier 2 auto supplier space. Healthcare, certainly, particularly given its size in the economy, but also state level regulation that started to impact on the healthcare services side. We're seeing more. We're seeing more there. I have to say this because I've been doing it for 25 years, but consumer retail restaurants, always in distress. There's always stuff to do. In fact, specifically in restaurants, I think a lot of the inflationary increases that were passed through post-COVID without a lot of consumer pushback, that's starting to change. And I think a lot of those businesses are starting to experience real weakness and consumer pushback. And then I'd say just in general, I mean, the fact that, after it was really early, you had the Russian invasion of Ukraine and then SVB failing, and we had a real interest rate environment again after not having had one for almost 15 years. People at the time said maybe we're in a higher for longer environment. Well, guess what? We're several years beyond that, and we're still in a higher for longer environment. And I think that hits a number of sectors, particularly low margin industries. That increased cost of capital really, it takes a bite out of these companies.
Right. Well, thank you very much, Richard. This has been great. Thank you, listeners. Really appreciate you being here, and I think we're good.
All right. Thank you. This was great.
Thank you. I really.
That was fun.
Yeah. I know we're competing with the Knicks.
We're competing with the Knicks, and our may still be open too. So that's a lot of competition.
Yeah.
Wow. That was great.
Thank you. Going to that I first, and it's going to be a campus be it. So they'll do this. So yeah, like it's. I think we're like maybe like getting